So you're all on the home straight. After me, there's only one more. And then you get to go back out in the cold and hopefully warm up and enjoy what London has to offer. So you have spent the afternoon hopefully hearing from a wide range of speakers about different asset classes, about markets, much of which is very familiar to you. What I want to do for this session is change your view, okay? I want us to look to a part of the world where 85% of the world's population live. 6 billion people live in emerging markets, but it's an area that, because people often struggle with the confidence and the understanding, is an area that we sometimes maybe lack when we think about portfolios. At JPMorgan, we've been running the Emerging Markets Investment Trust for 30 years. Okay? What I want to do is really bring to life how we approach the asset class and really give you a flavour of some of the stocks that we hold that we believe can really deliver and add to portfolio returns. So let's think about how we invest. We believe emerging markets is a long-term asset class. You've all read the headlines. You know these markets are volatile. They're called emerging markets because of the inherent instability. So we, as investors, feel we need to have a long-term focus, just as we would always encourage investors looking at our funds to have a long-term view. So the time horizon is really important. This isn't a short, sharp trade for you to be looking at. But to our mind, what you want to do is drill down. It is the biggest asset class. More than 25 different markets, thousands of different stocks. But to us, it's all about the individual companies. It's finding the right businesses on the ground in the likes of China, India, Russia, Brazil, and so on. And it's how those companies do their business. Okay, we spend a lot of our time, as I'll touch on, going out and meeting management. We don't just want to hear people say the right thing. It's about companies doing the right thing. Because what you've seen long-term in emerging markets is that delivers. They're the companies that succeed. They're the companies that really rise to the top. So why do we look from a long-term perspective? So what this chart is showing you, and I know many of you will have hopefully picked up the packs as well. If not, there's a lot more outside afterwards. This is looking at the breakdown of total returns in emerging markets, and you can use this across the world. What this grey area is showing is valuation. What does that mean? In the short term, you may well have heard this quote, the market is like a voting mechanism. It's basically a popularity contest. The market likes which companies it likes. Over the longer term, the company drives its own destiny. The market appreciates the substance of what that company is doing. Is the business operating in the right way? And management valuing minority investors. Are they thinking very sensibly about capital allocation? Where we want to be investing is, you can see from 60 months onwards, so 5 years onwards, companies where it's their earnings growth and their dividends that are driving it. You're not reliant on the market suddenly liking that stock and it becoming popular. What do I mean by long term? Okay, some of you may well hold this trust. As I said, it's been running for 30 years. There's one particular stock, and this is the 10 stocks we've held for longest. We've held since 1994. A Mexican supermarket chain we have held for over 25 years. We've also got here the likes of an Indian bank, HDFC. So we first bought that in 1998. Back in 1998, mortgages to GDP in India were about 3%. Okay, they're now up at about 11%. Excellent, going in the right direction. In the UK, it's 70%. These stories are multi-decade, not just multi-year. Finding the right companies, when they have a good run, you maybe trim the position a bit, but it's still, in essence, a good company. Okay, we've also got the likes of TSMC, which I'm going to touch on later, who makes semiconductors in Taiwan, Unilever, Indonesia, Bank Itaú, so a Brazilian bank, AIA, a Chinese, a Pan-Asian insurance company. What links all of these is it's the consumer. To our mind, what you want to be investing in is those 6 billion individuals living their daily lives, starting to earn a bit more money, and being able to make choices about where they spend that money. And what links these companies is the likes of quality of management, barriers to entry. So in Warren Buffett terms, a moat around them. It's very hard for anyone else to really come in and really start to penetrate the market share, at least sustainably. And companies where people will always spend money. regardless of what goes on from a geopolitical standpoint, regardless of what's going on across the world with the Federal Reserve in the US, people will spend their money, people will live their lives. People aspire for a higher standard of living, just as they do everywhere across the world. And to us, these companies epitomize the long-term opportunities that you have in emerging markets. The other thing that we find very interesting, and this is very much an output of the companies we invest in, is businesses that do the right thing tend to succeed. So this is looking actually at the carbon footprint of our investment trusts. So when we collate the information about the carbon emissions of all of the 58 companies we hold within the trust, the carbon footprint, you can see, is mere percentage points of the overall index. Think about it. The stocks that are most attractive to us from a long-term standpoint in EM are typically consumer-related. We have very little exposure to commodities. Commodities, heavy industry, manufacturing, because they don't offer good long-term returns. We want companies where we feel comfortable about the earnings stream. So the carbon footprint, again, I think is just a great illustration of finding the right companies, buying the right companies, buying the companies where management get it and are trying to do the right thing. So how do we do it? Very, very big asset class out there, as I said. It's all about people. It remains incredibly inefficient. You will have undoubtedly read headlines about emerging market companies where there's very limited transparency, where maybe accounting standards aren't up to scratch. That still happens. It's improving massively. Corporate governance is being taken very seriously, but you still need people on the ground. You will struggle to run money sustainably in emerging markets sat behind a Bloomberg terminal in London. You want to be on the ground. We have one of the largest teams in the industry. We cover 1,100 stocks in emerging markets. And people are very much our edge. So if I think about some of the numbers to really bring to life, and these are purely emerging markets members sat within the team that I'm in, 94 investment professionals, sat in 8 locations across the world. As of this year, we actually have 4 people on the ground in Shanghai, one of the first international asset managers to have people based there permanently. 21 different languages. Why is that important? I would suggest many of you have been on holiday before and had to rely on Google Translate to understand the menu and get something that you at least know vaguely what's going to be delivered to your table. Think about that if you go into a company meeting and you're relying on someone to translate what management are telling you. The chances are you will either end up making an assumption, you might just totally misunderstand. We have a fiduciary duty that when we invest clients' money in companies, we have a very good steer on what we think that company is able to deliver, that we're on the same page with management. So we ensure that all of the 5,000 company meetings we do a year, we conduct in mother tongue. So having people native to these markets is a huge plus in the way in which we go out and we try and differentiate between the winners and the losers. JPMorgan invests $150 million a year in research. That's not just my team, that's also US equities and international equities, but it really gives you a flavor of how seriously we take this. We believe that active management needs people. It needs technology. It needs experienced investors that are able to look at markets and understand whether the company falling is just because the whole market's been hit or whether something's actually changed with that company and the direction it's able to go in. Now, one of the biggest markets which has opened up in recent years that you may well have read about is the Chinese A-share market. So this is onshore Chinese equities. It's very much domestically orientated. It's actually the second deepest and largest market in the world behind the US, based on average daily volumes. It's huge. We already have 17 analysts covering China A-share stocks. This is the really big change, probably the biggest change we've seen in emerging markets for the last couple of decades by way of opening up the market and allowing access to those domestic Chinese stocks where 1.4 billion people are spending money day in, day out. So people, to our mind, are very much our edge in how we look to approach emerging markets and the stocks there. So what types of names resonate? What types of names work for this portfolio? I want to use an example of a global leader. So TSMC, Taiwan Semiconductor Manufacturing Company. Who here has an Apple iPhone? Quite a few of you. Excellent. Who here has one of the new iPhone 11s? Oh, excellent. Someone down there. I haven't yet either. I'm very much behind the times. I'm not a millennial. The Apple iPhone 11, TSMC made the semiconductor. That iPhone is 120 times more powerful than the first Apple iPhone. The whole point with semiconductors is you want to keep making them smaller, more powerful, and more efficient. They're everywhere in our lives. The average car has $500 of semiconductors in it. They're in our phones, they're in our smartwatches, they're in healthcare, and so on. And as of last year, TSMC overtook Intel, the US company, to become the largest, most developed semiconductor manufacturer in the world. A Taiwanese company is leading the way. This is a good example of a large cap stock. So this is about $280 billion. It's been very much a favored name. And again, based on 5G and artificial intelligence, this is exactly the type of company we think can keep delivering. If I now move to a small cap name, Globant, which I doubt anyone's heard of. We first bought this about 6 years ago when it was less than $1 billion. It's now about $4 billion. Globant is actually an Argentinian IT company. Okay, it's not domestically involved, so we feel very comfortable with the fact it's listed in Argentina, but it's Argentinian. We first got to know about this company when we were out visiting Indian IT outsourcing companies about 8-9 years ago. One of the questions we ask in every one of those 5,000 company meetings is, who do you see as your main competitors? Now, quite often, more often than not, you get names that you know because you understand the industry. But every now and again, people throw up a name of a really small company you maybe haven't looked at yet. So we went away and we looked at Globant. Globant, in more recent years, have worked with Disney. So they've helped produce these wristbands that if you go to a Disney park, it puts your fast track passes on, it puts your credit card on to allow you to pay. They've more recently worked with JPMorgan Chase, so our retail arm in the US, to help produce the app that allows you to take a picture of your check to pay it in. An Argentinian small cap company working with US and multinational companies. What you find in emerging markets is innovation and disruption. There's a lot of companies that aren't held back by bureaucracy, by we've always done it this way. They want to embrace technology. And so you're seeing a lot of leapfrogging by way of what these companies are able to deliver and why it becomes so attractive to global and developed companies to work with these smaller emerging market counterparts. Added to which, the beauty of the investment trust structure means this is exactly the right type of stock that we can hold. Because of the closed-end nature, it means we can drill down through that market cap spectrum and, as I said, buy a stock that's quadrupled in price in the last 6 years or so since we've owned it. Now, in terms of what that's delivered, and again, you'll see this in your pack, the point I would always make is consistency of approach. Remember, emerging markets is naturally volatile. Loads of different markets. Lots of confidence that swings around, sentiment that moves around as well. But the point is very consistent long-term delivery, both on an absolute and a relative standpoint. Why is that important, that long-term point? Because it's all about patience. I think this is a fantastic chart. So what this is showing you is if you invested £10,000 back in 2001 and you held your money, so you invested it in emerging markets and you held on. You held on through the global financial crisis. You held on through various impeachments, government overthrows, currency crises, you name it, it happens in emerging markets. But you just kept holding on. You received the equivalent of a 10% annualized return. If you got nervous or if you thought you understood the market and you wanted to try and time it, and you missed only 10 days, your return went down to 6.4% annualized. If you missed 50 days out of 18 years, you lost money. 50 days out of 80 years. The point with this slide is with emerging markets, it's about time in the market, not timing the market. It's an incredibly difficult asset class to time. Patience, long term. And you see that if you look at the track record of the trust. So as I said, we've been running this trust for 30 years now. You get pullbacks. There are clearly times that the market gets hurt. But these are good quality companies. You're buying, you're holding, you're compounding the returns. It's about having experienced investors that have been there and seen it, that are able to look through that noise and say, can that company still deliver? Is that company well placed still? Do management get it? All of these things are incredibly important for us. What you're actually doing is we're going out each day saying, do we trust management? Do management have the right motive and the right intent? And if they do, they tend to be better quality companies. And they're the companies that, as I said, become very attractive to us to buy and hold for, in some cases, as you saw, 25 years. So what do I want to leave you with? I could stand here all day and tell you countless stories about emerging market companies. But the problem with emerging markets still is everyone reads the headlines. I've worked in emerging markets for 15 years, and I could count on one hand the number of positive headlines that I've seen written about our asset class. It just doesn't happen. But the point with investing in it longer term is you're looking through the headlines, you're looking through the noise. Think about one of the main headlines in the world today. It's all about the trade wars. Yep, the trade wars are happening, they're continuing. They're probably going to happen until we get to the US election next year. Let's not be naive and think this is ever going to go away quickly. But that doesn't mean that 1.4 billion Chinese stop spending money, stop aspiring to live, stop putting soy sauce on their food each day or buying goods through their smartphone. All of this keeps happening, and the good companies will keep succeeding regardless of what's going on across the world. So the point I would make with emerging markets, and the reason I've put this picture up, is try and look past the headline and think about 6 billion people spending money. It's too big an asset class to ignore completely. You need to think about your time horizon. You need to think about how your portfolio is positioned. But just because it's not familiar doesn't mean it's something that you should totally write off. So let me leave it there and hand back. Thank you.